Imagine trying to direct a friend or loved one from out of state to your home for the holidays, but describing the roads to get to your house as they were 50 years ago. Do you think they'd run into problems along the way? Well, guess what? Your retirement presents the same challenges. Challenges you need an up-to-date roadmap to overcome. Listen up. We'll talk about those challenges today.
Welcome to the Ask Brad Show. Be prepared to hear ideas, concepts, and strategies that may challenge the way you were taught to think about saving and investing for retirement. It's time to roll up our sleeves and get to it. And now, the host of the Ask Brad Show, here's Brad Williams.
You know, every day, the American public's being force-fed investing advice from every direction. And, you know, some of it's spot on, but a lot of it's advice that made sense 30, 40, even 50 years ago. And some of it's just flat out wrong. If you follow this bad or wrong advice, it could prove to be an irreversible financial disaster to you. This is Brad Williams and the Ask Brad Show. And today we're going to set the record straight on what's fact and what's fiction and the most common retirement myths to make sure your retirement roadmap is up to date. Now, you know, one of the things I do on my show is covering things that people believe are true but aren't. You know, you get bombarded with the media, newspapers, magazines, articles, TV shows, radio shows, online blogs. And, you know, even your crazy uncle that's always got the best advice on how to make $1 million, but he doesn't have a penny. You know, there's endless advice on how to claim Social Security, how to claim Medicare, you know, the best ways to take money from your IRA or 401k, how to be diversified, you name it. I mean, you can turn on the TV and you're going to find it. And, you know, it can be really confusing. It make you almost want to turn everything off because how do you know what's right and what's wrong? Well, today we're going to talk about the 7 investing myths that could derail your retirement. And from my 32 years of experience being a financial planner, we're going to cover things like traditional rule of thumb for claiming Social Security that could cost you thousands. Tax policies that causes retirees to needlessly overpay the IRS every year. One-size-fits-all strategy on how much you should withdraw on retirement accounts that could really send you to the poorhouse and more. All these myths that people are using and going by today. Now, the first myth of our 7 retirement planning myths that can cost you a small fortune is that Medicare is going to cover your health needs. A lot of people think, wow, you know, I'm getting ready to turn 65. I'm getting ready to hit that magical Medicare age where now my medical costs are going to go down. Well, I think you may have a rude awakening. The latest estimates say out-of-pocket spending for the average 65-year-old couple, that means you're spending it, not Medicare, could go past the $400,000 mark in their retirement lifetime. Now, let me ask you this. Do you have a separate retirement account with $400,000 in it or that can have $400,000 in it to pay those? Most people can't. Now, mind you, this takes into account Medicare premiums, supplemental insurance premiums, deductibles, any copays, and anything that's not covered. Because a lot of people think Medicare covers a majority of the health care costs, and it's just not true. One insurance company recently came out and said Medicare will cover about 60% of healthcare costs. So you got the other 40 in your ballpark. So what we look at today from Medicare data indicates that you're about $7,566 per person in healthcare costs per year on average. So that's about $15,000 for a couple in their 70s. Wow. Think about that doubling at the age of 95 or older. So you got to start thinking about those numbers. If you're a married couple and both live to late 80s to early 90s, you're talking about some real money there. You know, a study by Hewitt Associates, which I thought was kind of interesting, says healthcare expenses can cost retirees 20% of their annual income. Think about that, 20% for healthcare. Most people think their biggest line item is taxes. You know, might be that healthcare costs are going to beat that out. And then we got to start thinking about the Medicare trust fund. because, folks, we got to admit there's issues there. So may not affect current retirees in tremendous ways, but meaning it may not be there for the younger folks in the way we have it, but there's still going to be challenges there.
At Brad Williams Financial Services, we believe in innovative thinking, and we're not afraid to challenge conventional methods in our approach to managing, investing, and preserving wealth. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048.
This is Brad Williams, and I have been privileged to have been an instructor over the last 12 years or so at the Osher Lifelong Learning Institute at the University of Alabama in Huntsville. They have some great course offerings. I'm currently teaching a course that I've written and taught for many years, Changing Face of Retirement in the 21st Century. But that's not all of the courses there. You can learn languages. You can learn hobbies, travel. There are so many things that you can get out of these courses they offer at the Osher Lifelong Learning Institute. So check it out today and come keep your brain working.
For more information on the Osher Lifelong Learning Institute, call 256-824-6183. That's 256-824-6183. Or email olli.info@uah.edu. The Osher Lifelong Learning Institute. Come keep your brain working.
You know, we're discussing Medicare in retirement. And, you know, when we look at healthcare costs, you know, we do have the typical medical costs, and then we got healthcare related to long-term care. And according to Forbes, nearly 70% of all people, that's 7 in 10 folks, who live to age 65 will require some type of long-term care. And the key is not whether you have insurance or not, but how you're going to pay for it. I sat down with one couple this week who had quite a bit of assets, and they were concerned about buying long-term care insurance. And I've done shows on that, and I'll do other shows on that. That's not the focus of today. But in their case, I was showing them how they truly had enough to self-insure if they desired that. Because Medicare, contrary to what a lot of people believe, does not pay for long-term care costs. They're going to pay for a portion of them if you go from the hospital to a nursing home, but for the most part, it's not going to pay for them. And private rooms, you could cost up to $8,000 a month. I mean, we're a little lower in Alabama, but still, even if it's $6,000, that's $6,000 a month. So, you know, that's something you got to take care of. Now, when you look at inflation on that, boy, that can have a real chunk of change out of your retirement. So, following up the 7 myths on the first one on Medicare, you know, it's not free. Your healthcare expenses outside of taxes, one of those is going to be the largest one. So, when you look at healthcare costs, Medicare is, that's a big deal, folks. And there's 4 parts of Medicare. You got the Part A, which is your medical insurance, Part B, and Part C, and then you got Medicare Advantages. And again, I'm not going to make this a show about Medicare, but you got to enroll when you're 65. And if you're on Social Security early, you don't need to. They're going to cover that, but that comes right out of your Social Security check. And, you know, you're going to see it before you get that. So when you're calculating your Social Security benefits, you need to make sure that you've adjusted for the fact that Medicare premiums are going to come out of that. You know, next thing is, do you have enough money in the stock market? You got too much, too little? How do you calculate, you know, your retirement income? So when we look at all that, it's important to calculate all these things we're going to talk about today. So one of the issues we've got is taking a look at having a plan. You got to have a written plan. You know, it's the old adage, if you fail to plan, you plan to fail. And what we'd like to offer to our listeners today is the 5-step retirement action plan. We're going to make this available to you at no cost. Just dial 844-343-6048. That's 844-343-6048. So if you'll call in, get our 5-step retirement action plan, no cost, no obligation. And, we're going to make it simple. Look at things, 5 critical pillars of investing, reducing biggest expenses in retirement, which are taxes outside of medical care. If you keep taxes low, you keep more money in your pocket. And it's what sources you're getting your income from that are important. In it, we'll address some unconventional strategies to get the most out of Medicare and Social Security benefits. So you're not going to pay anything for this analysis, and no sales pitch, no products for sale. We're going to offer that to the first 10 callers at 844-343-6048. Now, today, again, we're talking about the 7 retirement planning myths that could cost you a small fortune. When you look at all the media, all the newspaper, TVs, online blogs, everybody wanting to give advice. There's a lot of myths out there. One of the biggest myths I encounter on a regular basis is what's called the 4% rule. And this is something that can cause you to go broke. And then we're going to talk a little bit about tax benefits. But myth number 2, the 4% rule. Used to be that experts would say, well, you save $1 million, take 4% out, you have a reasonable chance of not outliving your money. Well, that's not really the case anymore. In fact, Morningstar over the last couple of years has revised that to 2.8%. Now think about that. You got $1 million saved. You're going to withdraw 2.8% to get you about a 90% chance of not outliving your money. But folks, that's before taxes. Some of these old rule of thumbs can get you into trouble. And we've been through a period of relatively low inflation. We've had record low interest rates. Stock market has been at record highs. Volatility is now back in the market. So you got longevity you got to worry about. If you withdraw 4% a year, that could leave you pretty much high and dry. You've got sequence of return risk, which I've talked about on many shows, which if you retire in a bear market, it's going to be a real impact on your portfolio, because it's when you get your returns and when you have the losses in your portfolio that really matters whether your money is going to last or not. Then when we look at the 4% rule, you got your minimum distributions from your retirement accounts, because in reality, that's a major tax consequence that the IRS is going to force you to take those withdrawals, which in the first year amount to roughly about 3.8%. So it's key to learn to control your taxes by planning ahead. And if you're over 50, it's time to start today, because taxes are a huge impact in retirement, and having a tax efficient strategy is going to save you a lot of money. And if you don't have one, if you're just assuming what everybody else assumes, it could cost you a lot. And let's talk about tax rates. What's the future going to look like? We got $21 trillion of debt. The Trump tax plan passed, it expires. So what is Congress going to do then? Well, it depends on who's in charge of Congress. So when you look at RMDs, they could increase your Social Security taxability of benefits. But controlling taxes is critically important in this day and age, because the IRS is just waiting for you to retire so that you can start taking that minimum distribution. They can start getting some of that tax money that they've deferred up until now. So I want you to give us a call for your retirement tax saving action plan. And if you call 844-343-6048, we can tell you how to get that. And this is going to help you put more money in your pocket and show you the different ways of taking distributions that will help you reduce your taxes and get more efficient income. So like I said, the IRS is just waiting for you to retire, because they cannot wait to get a hold of those taxes that they've been missing. So call right now and get your retirement tax saving action plan. To learn if you qualify, just call 844-343-6048. That's 844-343-6048. 844-343-6048.
Have you missed any of today's show? Would you like to listen to past shows? We've got you covered 24/7. Visit AskBradShow.com. That's AskBradShow.com. If you're preparing to retire in the next 10 years, this message is for you. One of the biggest sources of income may be how to claim your Social Security. That's right, how you claim your benefits. Do you know your full retirement age? Do you know how much your benefits may be taxed? Do you understand how to claim on an ex-spouse? Or even that you could? For your free commissioned report on Social Security maximization, call 844-343-6048 or visit us online at AskBradShow.com. You could spend hours and hours searching around online only to find some generic calculators that may not factor in inflation, tax implications, your marital status, and hundreds of other variables. For your free commissioned report on Social Security maximization, call 844-343-6048 or visit us online at AskBradShow.com.
Welcome back. You know, claiming Social Security benefits, generating income, reducing taxes, asset allocation, diversification, risk management. Boy, that sounds like a lot of balls to juggle, doesn't it? I mean, there are so many things that makes your head spin. This is Brad Williams in the Ask Brad Show, and I want to thank you for joining me today. And today we're talking about the 7 retirement planning myths or untruths. And our next segment, we're going to dispel the one-size-fits-all strategy of asset allocation, plus how a traditional rule of thumb for claiming Social Security could also trigger a bigger problem with higher taxes and Medicare premiums. And so, you know, everybody talks about 60-40 or 70-30 stock bond portfolio. Well, you know, there's more to it than that. Myth number 4 is the 100 minus your age myth of the stock to bond mix. And that's the way to go. And it's not that the rule of 100 doesn't work. It's just looking at only stocks and bonds to do that is the myth. So what that's saying is that as you get older, that you should reduce your exposure to stocks and put them into bonds. And with people living longer than ever, inflation is going to be one of the greatest threats that they face. Things are going to cost more. Stocks have proven to be one of the best inflation hedges available. So when you have higher prices, what do you think they are? I mean, when we look at what we pay for everything, about the only thing that has really remained reasonable is gasoline. So the problem we have in that old myth is that we've been in a period of a bond market rally for about the last 3 years. You know, we've had a period of generally falling interest rates, and now we're entering into a period of rising interest rates. That's going to impact the bond market. You know, when you buy a bond, an individual bond, you have 2 guarantees: return of your money and a set rate of return on your money every year. Barring any unforeseen chances, you know, that the company goes out of business, you're at the top of the creditor list. But the problem is most people buy their bonds in bond funds. And bond funds don't offer those 2 same guarantees. You don't own the bonds when you own a bond fund. You own shares in the bond fund. The bond fund owns the bonds. So if people are looking in that diversification and using bond funds in a period of rising interest rates, you're going to get some surprises. And if that's a concern for you, then that's something we need to talk about. So give us a call, 844-343-6048. That's 844-343-6048. And we can talk about how the traditional allocation of 60-40 bonds may be problematic in some ways. So that's 844-343-6048. Now, also talked about sequence of returns risk. And when you have too much exposure in the stock market, then that can impact that. Because again, when you have down years in the wrong part of retirement and the up years in the wrong part, it makes a lot of difference in whether you're going to run out of money or not. Now, when we look at our grandfather, I mentioned grandfather, they built a lot of their retirement on Social Security. They had bonds and they had CDs. Well, CDs paid a lot more. Life expectancies were shorter. Inflation was fairly tame and interest rates were much higher. Well, that's not the challenges facing you today. Unless you have a whole lot of money, and I mean millions, when you look at a 30-year time horizon, because my grandfather lived for like 33 years after he retired, and inflation is eating through that purchasing power, that is going to create a lot of risk, and that's a risk you don't need to take. So finding the right mix for a portfolio is very critical, and everyone has a different situation. You can't go to an investment salesperson and say, hey, here's my money, and then they go, okay, you conservative, moderate, or aggressive, and then they put you in that one portfolio and expect that to succeed. The times for that are over. So you got to take a customized approach to look at personal needs and personal purpose. I've talked about purpose-driven investment plan. When people come in to see me, I do see some that are doing the right thing, but I see a lot of people that are driving on those old roads we talked about. So myth number 5 is, as I mentioned earlier, are you going to receive the amount stated on your Social Security statement? Every year you get the ability to pull up your statement and look at it, and it tells you how much you're going to get in retirement. But that's before Medicare premiums. And it also is going to be impacted by what choices you make in your Social Security choices. So that's a key thing. I've seen differences between, $50,000, $100,000 in different claiming strategies. I think Forbes magazine came out with a article that as much as $10 billion is left on the table unclaimed every year with Social Security because people don't make the right choices. We've also got to look at the Social Security Trust Fund. If you read your statements front page, it's going to tell you why. Now, if you're right at retirement, probably not going to affect you too much. I know my 26 and 24-year-old daughters, they're going to need another plan because Social Security, I can't see how it will be the same way then as it is today. So that is a key aspect. So Social Security is one of those key things. And if you're not sure about your Social Security, give us a call, 844-343-6048, and we can do our Social Security timing report and let you know when the optimum time might be to take your Social Security, because there's many different claiming strategies, and all of them affect things like Medicare premiums, taxes, spousal benefits. So it's important you make the right choice up front. Just give us a call, 844-343-6048. and ask for our Social Security timing report, and we'll tell you how you can get one. No cost, no obligation. Myth number 6 is you won't live that long. Well, think about people around you. Are you seeing people that are making it into their 90s? I know I have several clients that have. So you've got to plan that into your retirement. One of the things I do for clients is do a financial plan. And more I'm having people say, I want mine not to be 87 or 89, but 95. So think about if you hit your 100th birthday, are you going to be able to afford to live? The fastest growing population age groups, the 85 plus. So think about that. Longevity means that you're going to have expenses for longer. Inflation will be more of an impact to you. And if you're going through a time of market turbulence, you got to figure that in there with sequence of return risk. So looking at having a plan is critical. And if you've not sat down and done a written plan, give us a call at 844-343-6048. That's 844-343-6048. We'll tell you how you can get a plan. Takes into account your Social Security, sequence of return risk, all the things we're talking about today, and puts it into a concise document that acts as kind of a financial GPS. Myth number 7 is you'll need less money in retirement. That old thing, well, when I retire, I'm going to be in a lower tax bracket. I heard somebody say once, if I retire in a lower tax bracket, then maybe I did something wrong. Well, that's one way to look at it, because you want to make sure you have the amount of income you need to live the way you want to live when you retire. I have some clients that build in some pretty substantial vacations into their financial GPS, and that's important to them. It's all about your purpose. It's really all about your purpose. You want to make sure that you have the right income for the lifestyle that you want to live. And you also need to factor in longevity. You need the right amount of income to make it through retirement without any road bumps. So when I look at that, when I show people the graphs of their income flows and their assets, it's an eye-opener for them. Because sometimes, you see this look of relief. Oh, wow, I didn't know we could do this. And other times, we're not going to be able to do what we want to do. Do you know which one it is? That's something you need to know before you retire. So call 844-343-6048 and ask how you can get your personalized financial analysis. That's 844-343-6048. So today we talked about the 7 retirement myths, and I hope that's been helpful, and I look forward to talking to you soon.
At Brad Williams Financial Services, we understand the struggles that families and business owners face today. We want to help you develop, implement, and monitor a strategy that's designed to address your personal objectives and individual situation. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048.
Hello, this is Brad Williams with Brad Williams Financial Services. Deciding when and how you retire is one of the most important financial decisions you'll ever make. Should you take a lump sum? Do you have to pay tax on this money? How do you invest the distribution proceeds to make sure you don't outlive your income? With such an overwhelming number of investment options, one of the most important decisions you can make is to seek the advice of an advisor. For this important partnership, you need a highly trained and experienced professional who sees your total financial picture. Someone who can help you define your life goals, establish the right financial plan, provide strategies focused on your needs, and help you stay on track. So if you or someone you know just retired or is thinking of retiring, give me a call today. I'll provide a tailor-made analysis of your retirement options at absolutely no obligation to you. Can you really afford to retire without knowing all the facts?
Call 844-343-6048 or visit us online at AskBradShow.com.
Imagine getting on an airplane. You just sat down and buckled your seatbelt. They've just closed the door, and the pilot gets on and says, "Folks, thanks for flying on our airline. We wanted to let you know that this is an older model. It's not equipped with a GPS, so we're going to have to fly by dead reckoning. And because the computer's outdated, we've calculated it. We have about a 90% chance that our fuel will get us to the destination." You think you'd stay on that plane? Well, don't make this scenario the story of your retirement. Today, we're going to talk about the 6 key aspects to a successful retirement plan. Now, I'm going to cover these 6 key aspects in a general sense, but they're also going to be targeted over the next few months for an individual show for each one of them. So as you get a grasp of these 6 key aspects. Now, mind you, this doesn't cover everything, but these are the main aspects of a successful retirement plan. Let's start with number 1, and that's Social Security planning. You know, that's probably a foundational aspect to most people's retirement plan that are, 55 and older. I know some people who are younger than that probably have some misgivings. That's a topic for another show about the efficacy of Social Security, but I feel pretty comfortable. There'll be few changes for me, at least for the near future, and that's how most people are, especially in their 60s. But that is that one thing that drives a lot of activity. You know, when should I retire? Well, I'll be at least 62, or I'll be at full retirement age, whatever that is, 65, 66, 67, depending on what year you were born. Again, that's one of those first decisions people make. And I know I've been in this business for over 30 years. And in the early days, when I'd be sitting down with a couple and planning out strategy as far as when they should retire, one of the key questions we would always get asked, or I'd get asked, and I'm sure other financial advisors are the same, is when should I take Social Security? Well, we really didn't have efficient tools back then to make educated decisions. And a lot of times it was just a fact of, well, do you live long? Does your family live long? And if that answer was yes, well, then you might want to wait and max it out. And if the answer was no, you know, we all die in our mid-70s or something like that, then taking it early may make sense. And that's about as scientific as it got. Well, today there's several very efficient planning tools. I use Social Security Timing for my software that will print a report and show you all the options. And there are many. And so having the right data to make that initial decision on when is best to take Social Security is really important. And you got several key aspects of timing your Social Security, and that is when you hit 62, of course, you can take it. That's the earliest you can take it. When you hit your FRA, which is your full retirement age, that's when you max out your benefit as far as for your spouse. And what I mean by that is that if you wait till after full retirement all the way up to age 70, you get an 8% deferred retirement credit by waiting after full retirement age. So, for example, if you're 65 and because of your age you qualify for Social Security this year at full benefit, you'll get an 8% growth in that payment, that monthly payment, each year you wait until you're age 70. And then obviously at age 70, you don't want to wait any longer because there's no benefit to it. You're leaving money on the table. This is one of those key aspects that are very important to know the numbers. Now, some people have to take it because they have income gaps. Some people can wait. The key is don't guess. Don't just throw a dart at a dartboard and guess. And don't leave money on the table because some of the different options can mean the difference between $20,000, $50,000, $60,000, even more over your lifetime to make the right decision. So the number one aspect is Social Security. There's a great book about your money that was written by a good friend of mine, Dave Scranton, and it's called Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. And I'm going to offer that book this week. That's my weekly giveaway for the first 3 callers at 844-343-6048. It's like a $25 value on Amazon, folks, but it's at 844-343-6048. It is a great, well-written book by a very, very smart guy. In fact, he's got a television show on Newsmax called The Income Generation. In fact, I've been on it a couple of times. But his name is David J. Scranton, and I'd like to provide that book to the first 3 callers. All right, the 6 key aspects to a successful retirement plan. And we covered Social Security in one. And the next is income. And these kind of dovetail because, as I mentioned, Social Security is a key foundational planning aspect. But where are you getting your income is going to drive some of your Social Security decisions as well. Are you getting a pension? Are you a federal employee? Are you military? Do you have a corporate pension? And frankly, those are shrinking. There aren't many people covered under corporate pensions anymore. And even the ones that are there, a lot of them have quit contributing. They've just kind of frozen your benefit where it was at the date they decided not to do that anymore. And the reason being is with low interest rate environment we're in, that puts a tremendous amount of financial liability on the company in the aspects of managing it, getting the adequate returns to make sure it's fully funded. And when they talk about fully funded pension, it means that if they've got $1 of projected benefits, they've got $1 of assets to cover that or more. You may have heard the term overfunded pension. That means they've got more than $1 for every dollar of liability. The problem with a lot of pensions is that they're way underfunded. And especially some of these municipalities, the state of Illinois is in dire shape when it comes to their pensions. They've just kept voting more and more benefits without putting adequate money into the plan itself. But making the right choice on pensions is really important. Now, sometimes you'll get the option of having a spousal benefit where you can reduce your benefit to make sure that if something happens to you, your spouse continues to get that benefit for their life. That can be 50%, 25%. It really varies. That's really not a topic for this show, but making the right choice there is important, and taking a look at things like the health of you and your spouse. Is it pretty well assured you're going to outlive your spouse short of an accident? Then that factors into what choices you make there. In some cases, it might make sense to take the higher pension and just guarantee one life. And then if you got adequate insurance or it makes sense to have insurance to cover that, then you basically cover your own pension. And that's a case by case basis. And it really depends on what factors the pension's using to drive their benefit. That's really a calculation that needs to be made at that time. And then looking at some planning strategies, like would it make sense in the early years of your retirement to wait on Social Security and let it grow till you hit age 70 and take distributions for a short period of time out of your retirement accounts and have them fund you until your Social Security maxes out and then turn that on? And for some people, that's a very viable and recommended strategy. But again, that's a case by case basis, and it requires sitting down and doing the requisite calculations. Factored in things like your required minimum distributions, which when you hit 70 and a half, have to come out of a retirement account, an IRA specifically, and a 401k if you've already retired. The only exception to taking an RMD at 70 and a half is if you're still working, but that only applies to the 401k that you're currently funding. If you've got other 401ks from previous jobs, you're going to have to take RMDs from those. Again, RMDs and IRAs, that's a topic for another show. I'm just trying to cover the basics. You may have rental income or dividend income. In fact, it's recommended that you set your retirement accounts up in many cases to fund your RMDs through dividends, because then you're not having to sell shares and eat into your principal to fund those RMDs. So, when we break that down, it's setting the right strategy, looking at the whole picture and determining how best income should be drawn. What accounts first? I often use a bucket approach, a now bucket, a later bucket, and a maybe bucket. That's one strategy, but there's many. The key is that you have sat down and developed the strategies on paper and know the scenarios and know the options are available for each. There's a great book about your money that was written by a good friend of mine, Dave Scranton, and it's called Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. And I'm going to offer that book this week. That's my weekly giveaway for the first 3 callers at 844-343-6048, 844-343-6048. It is a great, well-written book by a very, very smart guy. But his name is David J. Scranton, and I'd like to provide that book to the first 3 callers.
At Brad Williams Financial Services, our goal is to develop enduring, long-term personal relationships with our clients, knowing that you have placed your trust in our expertise and dedication. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048. A message from Brad Williams Financial Services, LLC, right here in Huntsville.
Is your financial advisor performance-driven or purpose-driven? What I mean is, when you meet with them, is it all about returns and numbers, or is it about you, your family, and your quality of life?
Do they know your goals, your aspirations, and the desires you have that you hope your money can achieve? Did they even ask? Is your financial advisor a partner in your retirement or just someone who sends you reports? If you're looking for an advisor to be more of a partner for you and your spouse in retirement, call Brad Williams Financial Services at 844-343-6048. Call today and schedule a free 1-hour, no obligation consultation to discuss your goals and aspirations and see if we're a good fit. That's 844-343-6048.
No one needs to tell you we live in an era of financial uncertainty. As a thank you just for listening to our program today, we're offering listeners who call in or log on a complimentary copy of the new book, Return on Principle, 7 Core Values to Protect Your Money in Good Times and Bad, from best-selling author and financial coach David Scranton. Filled with in-depth analysis from financial overprotection to financial fearlessness, Return on Principle tackles them all. Steve Forbes says David Scranton offers perspectives investors should not ignore in these turbulent times. Return on Principle takes baby boomers through a journey of discovery, not blame. For your complimentary copy, call 844-343-6048. That's 844-343-6048. Or visit us online at AskBradShow.com. That's AskBradShow.com.
All right, welcome back. And when it comes to income, there's taxable, there's tax deferred, and there's tax free. And one thing that's often neglected by planners, by investment advisors, by people in general, is building up a certain amount of each one for certain purposes, because there are certain years you may want to take out of this one. Some of the years you want to take out of that one. By having a choice and a blend of taxable, tax deferred, or tax-free income, it gives you some leverage and some choices. You know, just a really important thing to have in that retirement plan structure. And if you have any questions about that and would like to talk and ask questions about what that means to have a different tax structure for income, just give me a call, 844-343-6048. I'll be happy to spend some time on the phone with you. It's 844-343-6048, and we can talk about that. Now let's go into our third key aspect, and that is taxes. And I mentioned that in the income range, but that's where that multiple bucket comes into play when you're talking about tax planning for income. You may have reasons why you want to defer certain things, that it makes more sense to take out of a taxable bucket this year because you've had a lower income from other areas. And then having some tax-free income may be important in those years that you have, some windfalls, things like that. The key about taxes is that you want to plan that out strategically, tactically. One thing I give out to my clients is a tax cheat sheet. And I'd be happy to email you one, no cost, no obligation, 844-343-6048. Just ask for the tax cheat sheet. And we got it in digital form, and we actually have a hard copy. We'll send you either one. Again, no cost, no obligation. It lays out all the taxes just that you could just about deal with. And it also has Social Security issues, Medicare premiums, your RMDs. But these are the type of things when you're doing planning for taxes in retirement that you need to know. And most people don't know that your income affects your Medicare premiums the next year. I've had people come in when we first started working together say, hey, last year my Medicare premium went up. Why? And I had to explain it to them. So I think when it comes to all the aspects of retirement planning is don't guess. Don't just wade into retirement. You need to have a written, dynamic plan. And what I call a financial GPS. If you remember when I opened the show, I mentioned that plane didn't have a GPS. Well, and I've said this on other shows, a GPS tells you how to get back on course. Most people don't realize when you are flying on an airline that plane is off course most of the time. But because the GPS catches those subtle changes that come from turbulence and headwinds and temperature gradients and weather and things like this, similar aspects to what happened to you when you're in retire. The economic climate doesn't stay the same all the time. That GPS makes those subtle changes before they become big changes. And so that nose gets brought back onto course and the plane continues on to its destination. So that's why having a plan, and what I do with my clients, we sit down, have a written plan that includes all this. And it's a plan that is like a GPS in that it is not just a document that sits there and gathers dust on a shelf. It's something you use, a foundational plan that gets altered on a regular basis as economic changes, financial changes, family changes, targets move. So you need to be able to adjust your sights on them. Now let's get into the fourth aspect of a successful retirement plan, and that's medical costs. Because of all the costs you're going to incur in retirement, medical costs, you can read article after article. And I'm not talking about long-term care, nursing home type issues. I'm talking about medical costs, operations, medications, all these things. And so as you're getting close to retirement, you need to be asking questions of your HR people at your company. Do they have a way for you to continue your medical insurance in retirement? Some still do. A lot of them are getting away from that. Some companies even allow you to stay on and use a supplement that they've got negotiated with their carrier. That brings up another topic, which is you need some kind of supplemental insurance to match your Part A and Part B Medicare. And you can use a Medicare Advantage, or you can use your typical Medicare supplement. And, there's valid reasons to use either one of them. Again, that's probably a show in and of itself, is which one you should choose. But looking into those aspects prior to retirement, one of the biggest mistakes a lot of people make is they may be a month from retirement. They're hearing this show and they're like, oh my God, I never realized how many decisions I had to make. And all they're doing is counting down the days till they get to walk out of the office. And they really don't think about what's waiting for them once they retire if they had made plans in advance. So it's best that, 5 or 10 years before retirement, you really start honing in on some of these things so that the actual date of retirement, you're already set up. You've already got a plan. It's just sticking with the plan and adjusting the plan as need be. So medical costs are going to be a huge part of retirement. Now, part of that is, of course, long-term care. Now, some have long-term care insurance, some don't. There's actually more ways than traditional long-term care insurance to deal with the chronic illness situation that causes so many people financial ruin. And I think what's important about that, though, is that whether you're using your own assets and pledging, a certain part of them to cover any of those costs, whether you're partially or fully insuring it with traditional long-term care insurance, or whether you're using one of the new hybrid plans that maybe even have an annuity base or a life insurance base. What's important is that you've reviewed all those options and you've determined which one makes the most sense for you. And for several years, this was years before I opened up my own office and hung my own shingle, that's all I did was long-term care planning for clients. And there are so many aspects of that you just really can't do justice if it's just a once in a while thing you deal with long-term care insurance. That's too important a thing to, it's the same reason you wouldn't go to a divorce attorney to do a trust. I mean, he may be good at it, but for the most part, you'd want to use them in their specialty. Knowing these different long-term care options is real important. There's a lot of good people that know them, and then a lot of people that just kind of dabble at them. So, just make sure you're dealing with someone who really understands them. If that's one of those key things in retirement that you want to talk about, just give me a call, 844-343-6048. That's 844-343-6048.
and would be more than willing to have a phone conversation to talk to you about that. I think every one of these planning aspects is really important. Any one of them can create havoc in a retirement. So start addressing those in advance. The 6 key aspects to a successful retirement plan. We got 2 more to go. And number 5 is risk. And when I talk about risk, I'm talking about market risk. I'm talking about interest rate risk, and I'm talking about sequence of return risk. Now, that's going to be a topic of another show. I've already done a show on that. But when I talk about market risk, I'm talking about the risk of loss in the market. Now, markets trend up over time. It's the best inflation hedge. The problem most people don't think about is that as they get older, they need to be reducing their risk. And there's several ways to do that. There is no one hard and fast way to do that. And there are many tools out there to help you do that. But it's something that should be looked at. How much of that hard-earned money do you feel comfortable having at risk? Because as we've seen the last 10 years since the financial crisis, due to low interest rates, the stock market has exploded. Now, that party is going to end. Logically, it would have said it would end it already, but there's been many things to cause it to continue. Well, it's going to end, and it'll be, in the near to moderate future. So being prepared for that's important. Interest rate risk is another, because as interest rates rise, it brings a whole new set of opportunities and problems. I'll give you a quick one. Bond funds have been used by many people. You hear that 70-30, 60-40 stock bond portfolio, and especially in 401ks, bond funds are widely used for that bond aspect of it. Well, one of the things that's coming in the future as we see interest rates rise is that bond funds are going to present a lot of problems, because one of the big areas of returns that bond funds have been in an interest rate environment that causes interest rates to drop is that it causes bonds to appreciate. You buy a 6% bond and interest rates go to 3%. Well, people will pay you a premium for that. And as interest rates, if you bought a bond at 3% and interest rates have gone to 6%, well, nobody wants your bond because they can go get a 6% bond. Now, the problem in mutual funds is you don't own the bond. So you don't have the 2 biggest guarantees an individual bond has, and that's a guaranteed return and return of your money at maturation. So then you have sequence of returns risk, which is, if you're having bad years in the early times of retirement, it could wreak havoc in your income plan later on. So it's when the drops happen that's real important. As you can see, there are many layers to a successful retirement plan. And you've got to address each one. And it pays to work with someone who looks at all these aspects on a regular basis. And so that's where I come in and say, do you have a financial GPS? Is your plan your financial GPS? Well, if you don't have one, give me a call. I'll be happy to talk to you about it. 844-343-6048. That's 844-343-6048. There's a great book about your money that was written by a good friend of mine, Dave Scranton, and it's called Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. And I'm going to offer that book this week for the first 3 callers at 844-343-6048. It is a great, well-written book by a very, very smart guy. Now, I want to thank you for listening again. I lately been getting a lot of great comments from listeners. If there's topics you want to hear, let me know. You can email me at brad@askbradwilliams.com if you don't want to call in. That's brad@askbradwilliams.com. And you can visit our website, askbradshow.com, and listen to previous shows, and it'll keep you up to date on shows coming.
That's all the time we have for today. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048. 888-888-4848.
Investment advisory services offered through Sound Income Strategies, LLC, an SEC-registered investment advisory firm. Brad Williams Financial Services and Sound Income Strategies, LLC are not associated entities.